Hey guys, it's Serge here. Today we're going to do a little strategy session on gaps. Particularly, there are interesting trades uh, that set up when you have gaps on both sides of the market. I'm going to explain that to you guys here in just one second. But at the very basics, just to quickly recap what gaps are, not to bore anyone that knows how these works. Let me quickly just go through. So basically, gaps tend to happen after a bit of news. They can be up gaps or down gaps. In either direction. If you look at, for example, here, this is the stock of Whole Foods, so we're going to look at the trade here in just one moment. But you can see, for example, last November, and this was gaps usually come after an earnings report or some major news that affects the stock, the sector, or the broader market itself. So a lot of times for equities, it tends to be around earnings. So after an earnings report, a lot of companies report after the close of the market or before the market opens. And so you can see some pretty dramatic news come out, and the stock the gaps up or down. In this case, it gapped higher in last November, and the stock continued to go up. Now there's this false thesis out there that all gaps fill, and for one, it's not true, and B, in other words, so let's say we had an up gap here in November. Some people will then try to lean against it and try to short the stock for it to fill. Now, that's not only a catastrophic trading strategy, but also just you going on a false premise. So for one, not all gaps fill, and B, if they do eventually fill, it doesn't mean they have to fill anytime soon. So let me get right to the example. So right now, the latest earnings report in Whole Foods knocked the stock down just a couple of weeks ago in early this month in early May, and the stock now basically has unfilled gaps above it and below it, and that's what makes this so interesting. So gives us a really interesting trade, because basically one of these two gaps is gonna so one of these gaps is naturally gonna fill before the other, or at least part of it. That's how it's gonna work. There's no way around that. That's a fact. So the gap on the upside is I'm just drawing it in here. That's a blue box, and the one that's still unfilled below here from November looks something like this. So the stock here is now stuck in this really tight range, and it's either going to fill the gap up here, or at least part of it, or the one down here, or at least part of it. So a very simple strategy that you can do in this situation is if the stock starts moving into in this case the upper gap, so a move above, like, say $43, $50, $44 or so, you have to kind of be, you have to make your own rule on exactly where to get in. But the point is, once it starts moving into this gap, you can start buying it. And the same thing at a downside. If a stock starts breaking down in this case and starts filling this gap, there's a good chance it's going to gravitate towards the lower end of it. So very simple way of trading gaps. Hope this makes sense, guys. Please like this video and subscribe to the channel. If you're interested in trade alerts and education, go over to thesteadytrader.com. If you want to follow me on Twitter, my Twitter handle is SteadyTrader, and I'll see you in the next video.